All right, let's get right into it. We're about to pull back the curtain on what could be the single most important and most hidden financial secret in the entire world.
So, let me ask you something. What if I told you that the biggest, most powerful market on the planet is one you never actually see? A market that operates completely in the shadows, but quietly has its hand in everything, from the price you pay at the pump to the safety of your retirement savings. Well, guess what? That market isn't hypothetical. It's real. And this is its estimated size. That's $700 trillion. It's a number so big, it's almost impossible to wrap your head around, right? It just sounds like a made-up number. But today, we're going to break it down and give it some real meaning.
So, welcome to the invisible market. Think of it like this hidden global system of contracts and promises. It's basically the scaffolding that holds up our entire financial world. Okay, to really get a sense of the scale here, just look at this chart. See that smaller bar? That's everything. I mean, literally the value of every single product and service the entire planet produces in 1 year. That's our global GDP. Now look at the bar next to it. That's the derivatives market. It doesn't just dwarf the real economy. It's more than 7 times bigger. It's just staggering.
So the big question is, what exactly are these things that make up such a mind-bogglingly huge market? Let's dive in and decode them.
Okay, at its absolute core, a derivative is just a contract. It's a piece of paper, essentially. It doesn't have any value by itself. Instead, its value is derived from something else, what we call an underlying asset. And that asset could be almost anything: a share of Apple stock, the price of a barrel of oil, even something as abstract as the interest rate on a government bond.
So a good way to think about this is, don't picture them like something you own, like a house or a car. It's much better to think of them as sophisticated bets. Or you could see them as insurance policies on where the price of that other thing is going to go in the future.
And these contracts come in a few different flavors. The big three you'll hear about are futures, options, and swaps. Now, they each work a little differently, but they all boil down to the same thing: making a bet on or protecting yourself from future price changes. This is a huge reason the market is so massive. It's the financial plumbing that lets businesses all over the world manage their risk. Let's zoom in on two of the most common ones: options and futures. The difference here seems small, but it is absolutely crucial. With an option, you get the right to buy or sell something later, but you don't have to. It's a choice. A future, though, that's an obligation. You are locked in. You have to do it. Think of a farmer who uses a futures contract to guarantee a price for his crop months from now. He's obligated to sell, and the buyer is obligated to buy. It's really the difference between having a choice and being locked into a commitment.
And that's where all their power comes from. But here's the thing: that power is a massive double-edged sword.
The secret ingredient here is a concept called leverage, and it's exactly what it sounds like. It's like using a physical lever to move a giant boulder you could never lift by yourself. In finance, it lets you use a tiny amount of your own money to control a huge financial position.
So here's how that works in practice. You put down a small initial payment, right? But that little bit of cash gives you control over a much, much larger pile of assets. So if the market moves just a little bit in your favor, pow! Your gains are magnified like crazy. But, and this is the part you have to remember, the exact same thing happens in reverse. A tiny move against you can lead to absolutely devastating multiplied losses.
And this is where it gets really dangerous, because that magnifying effect isn't just a problem for one trader who makes a bad bet. When this stuff goes wrong on a big enough scale, it can threaten the entire global system.
Yeah, see, in this huge, interconnected web of a market, when just one big piece gets into trouble, it can set off a terrifying chain reaction. It's like a risk domino.
The technical term for this danger is counterparty risk, but don't let the jargon fool you. It's a simple and frankly terrifying idea. Remember, these are all just contracts, promises between two parties. Counterparty risk is just the risk that the guy on the other side of your deal won't be able to pay up when the bill comes due.
So, let's just imagine how these dominoes fall. It all starts with one major player, say a giant bank or a hedge fund, taking a huge unexpected loss. All of a sudden, it can't make good on the promises it made in all those derivative contracts. And there it is. The first domino has just been tipped over.
Okay, now think about all the other banks and funds that were on the other side of those deals. They were all expecting to get paid, but that money, it's just vanished. It's not coming. So now they're in serious trouble. The risk is spreading like a virus. It's become contagious.
And that's what kicks off the final stage, pure panic. Suddenly, nobody trusts anybody else to pay their debts. The entire invisible web of promises that holds the whole system together, it starts to rip apart. And that's when you're looking at a potential systemic collapse.
And that right there, that reveals the fundamental secret of this whole thing. The biggest financial system in the world, it isn't built on hard assets like gold bars or skyscrapers. It's built on something invisible, a massive interconnected network of promises. So that leaves us with one last pretty unsettling question, doesn't it? In a system built entirely on trust, a system so huge it's almost impossible to even comprehend, what happens to all of us when those promises start to break?